On this episode of the Chris Elliott Real Estate Show, we're talking all things mortgage with Adam Gjerulff of Geneva Financial, and out of the show.
Welcome to the Chris Elliott Real Estate Show, where we bring you insights into the local Central Virginia real estate market, go in-depth to answer your real estate questions and concerns, and interview local figures and influencers in the greater Richmond area. And now, let's get to the latest episode with your host, Chris Elliott, and co-host, Maddie Ray.
All right, so we've got Adam Gjerulff of Geneva Financial. Adam, how are you doing, my friend?
Doing great, Chris. Not as good as you at the beach, though, man.
We are at the beach. The production quality on this interview is amazing. If you saw my setup, you would get a good laugh. We got literally like nightstand lights without the laid, shade covers for lighting. I think they're about to put a roof on the house next door that got tore up with Dorian. So I'm sure our audio on this podcast will be great. But anyway, appreciate you coming on the show, my friend. So Adam is a mortgage lender. I'm going to let him tell his story. But we are happy to have Adam back on the show. We've done some previous content with Adam, but we wanted to answer some questions that we've had from clients that we've gotten from social media, and just let Adam kind of explain some of the intricacies of real estate finance. Adam, before we jump into the meat of it, can you give us your background? How did you get in the mortgage business? What did you do beforehand? And maybe tell us a little bit about your experience up to this point.
Sure. Yeah. So I got into the mortgage business in 2005, before the crash. And before that, I got out of school.
Good time to be in the business for
it was a good year and a half. It was solid. But I've been in it ever since. So I've seen the good and the bad. And before that, I was in school and I moved to Florida and I was actually valeting cars, just hanging out after graduating from college. And
crushing it.
Yep. Met a friend who was in the mortgage business, and the rest is history.
Super cool. Super cool. And you've recently opened your own firm, from what I understand.
Yeah, it will actually be 2 years in November. It's actually a branch of Geneva Financial. So I have the Richmond branch of Geneva. We're actually based out of Arizona, and it's going great.
Cool. Yeah. Very cool. Good deal. All right, so let's just jump into these questions. We don't really have much of a format for this particular show, so it's just going to be some random questions. But a couple of these are more geared towards first-time home buyers, maybe somebody not as familiar with the process. But can you cover with us what is a loan officer? What do they do? And how do they fit into the picture? And how does a loan officer or loan originator differ from, say, a mortgage processor, an underwriter, and some of these different people that are involved within the process that we hear about? But I feel like anybody outside of the real estate space doesn't really know what these people actually do and what their responsibilities are.
Sure. So a loan officer, and it differs a little company to company, bank to lender to broker, et cetera. But for our setup, the loan officer is going to be the buyer's or the borrower's primary contact throughout the process. So what I do as a loan officer is I will speak to somebody looking to buy a house, gather the loan application, get all their pertinent financial information. The first thing we do is pre-qualify somebody. So that's basically taking the income, the assets, and the monthly liabilities and figuring out, okay, what's the maximum that Chris Elliott can afford to buy a house at. And from that point, the loan officer is basically the liaison between the buyer, the processor, the underwriter, and the closer. So all of our ops team. And so the loan officer is really the director. He's the one, he or she are the one who is directing the loan, talking to the borrower on what's the best option for you, showing the different loan finance options, and then also helping the processor and underwriter get this file approved and get it to closing.
Gotcha. So would you say a loan officer, a loan originator is pretty much like the quarterback of the financing side of the transaction? Would that be an accurate analogy?
Yeah, that's a great analogy.
And that's what we tell our clients. I mean, pretty much the real estate agent is there to guide you through the overall real estate transaction. That's what we do on our side, but the loan originator is going to be your liaison, the person that's holding your hand throughout the whole financing component of it. So good deal. Okay. Next question. So you kind of touched on it, but what is a pre-approval? What all is involved with getting a pre-approval? how long does it last for? That's one of the things that we're always looking to do as soon as we can, as early in the process as we can, is get somebody pre-approved with a good mortgage lender. Can you cover with us what is a pre-approval?
Absolutely. So like you said, it's very important to have a pre-approval and a solid pre-approval at that. Basically, you're taking a loan application with a property address that you're buying is to be determined. So there's no property address at that point. It's basically taking your income, asset, credit information and fitting it into the box to what your approved amount would be. Regarding the pre-approval process, again, it differs by bank or broker. For our process, I'll gather all the information from the client. We'll run 90% of the time we're doing the file either conventional, FHA, VA, or USDA. So we'll run that, the necessary underwriting associated with that program. If the file has any sort of possible hurdles on it, we'll send the file up to an underwriter to actually underwrite the file. But typically, if we have a desktop approval and if you have an experienced and professional loan originator you're working with, you should be good to go based on the information you provided them.
Cool. And I'll tell you, one of the reasons that we love sending our clients to you, Adam, and good lenders like yourself is, you guys do a good job of getting somebody pre-approved. So when you tell them, hey, you're going to be able to buy, you're going to be able to, buy this much, it's usually, so long as the client doesn't screw something up, you're good for your word. Where some of these firms, they just hand out pre-approval letters like they're candy. And I think that's where lenders get a lot of a bad rap sometimes. It's just you have a few bad apples out there just doling out pre-approval letters without really doing the proper due diligence.
Absolutely. And that's a big red flag for any consumers out there working with a lender. If they're giving you a pre-qualification letter or pre-approval and you haven't sent them one document associated with your income or assets, I would run. That's not somebody you want to work with, because basically they're just typing in numbers into the computer and saying, here you go, and hoping for the best.
Yeah. So maybe touch on this a little bit more. But so one of the things that I'm kind of going off script here, but one of the things that we hear a lot is, hey, we tell people, hey, you need to get pre-approved, and they say, don't worry, I've got good credit. Maybe they've been keeping it up with creditkarma.com, or, now a lot of credit card services are offering this. But can you go into kind of what qualifies somebody outside of just credit?
So the debt to income ratio is something I'm sure you've heard. And that's basically your monthly income versus your monthly liabilities. So somebody with a 780 score has great credit, but they might have $5,000 a month in monthly liabilities on that credit report. So you have to offset that with the income. W-2 employees, it's a little bit more straightforward. If you have a salary, it's pretty easy to figure that income out. But if you have self-employed individuals, even if you have a W-2 employee who might have a Schedule C income with a side business that's showing a loss, that could affect your approval with the loan as well. So there's a lot more details that go into it, specifically income and assets outside of the credit that's going to help you get approved or not approved.
Gotcha. Cool, man. All right, pulling back up our list. All right, so is it always, and I get this one a lot, especially from first timers that are maybe they're waiting to buy because they say, hey, I don't have the 20% down payment yet. Is it always better to put down as much money as possible, or are there times where it makes sense to maybe keep some of that cash on hand, or go into that for us? Because I know that's a conversation that you guys have a lot.
Yeah, and I'm a big proponent of keeping cash on hand. I mean, putting a good chunk down is always good. It's going to help your monthly payment. But depending on the product, conventional products, with mortgage insurance, it's based off your credit and how much you put down. So I actually was looking at one yesterday. It was a $280,000 loan. If they put 15% down, the mortgage insurance was $42 a month. So it wasn't that large of an amount, and it saved them an extra 5% that they'd have to put down, which was tight for them to do. So you definitely talk to your loan officer about that. I mean, every situation is different, which is why I love my job. And everybody's preference is different. if in the long term you plan on being in that home for 30 years, putting 20% down might be the best option for you. But the reality of it is most people who buy a home either refinance or sell the home within 7 years. And that's a conversation I have with all my clients that most people don't really think about when they're looking to buy a home. It's, what's your long-term goals with this property? How long do you plan on being in the property? Specifically for first-time home buyers, it's not going to be, more than 5 or 6 years. So using all of your assets, all of your liquid assets to put down on the property just might not make sense.
Yeah. Never a bad idea to have some emergency funds, or, you and I both know once somebody moves in, they're buying new furniture typically, and they're upgrading other things. So pretty good to have cash on hand. So cool. Next question, what are closing costs? What makes those up? Are they negotiable? I hear on the radio that a certain firm, not to be named, doesn't charge closing costs. Bust the myth for us on closing costs.
So there's different parts of closing costs. One, you have your lender fees. So every lender out there has a fee. They show them in different ways, but it's an underwriting and a processing fee. Typically, we just lump the two together. You have your prepaid items. So if you choose to escrow your taxes and insurance, and then there's going to be odd days interest associated with that. So that's basically escrowing, setting up your accounts for escrow. We can go into that a little bit more later if we'd like. And then you have your title fees. So there's always title insurance, whether you want it or not, you're going to have lender's title insurance. And then the title company's fees outside of that. In addition to that, you have, in the state of Virginia, you have transfer taxes as well. So those are costs that are associated with any loan, whether they say it's a no closing cost loan or not. They can be paid for by the seller or by the lender. And the way that the lender pays for it is just by increasing the interest rate. All lenders have the ability to do that. And then you can talk a little bit about seller credits, but seller credits can be up to anywhere from 3 to 6%, depending on the loan product. And you can use those to pay closing costs as well as buy down your interest rate. Another portion of closing costs would be if you chose to buy down your interest rate, that would be an additional portion of closing costs as well.
Okay, very good. So to recap, so if somebody's hearing that on the radio, TV, wherever they're seeing it, that there's no closing costs, they could maybe be rolling those fees into the interest rate that they're actually being charged.
Yeah, nothing's free, Chris. You know that. And the state's going to get their money, and there's title fees associated with any loan. So they're just doing what any other lender would do, which is increase the rate and give you a lender credit towards those closing costs.
Gotcha. Okay. All right. And last question. If I'm shopping lenders, which we always encourage clients to do, keep everybody honest, shop different lenders. What should somebody look for? What questions should they ask? And what criteria or what, measuring sticks should they use to choose the right lender for their purchase or for their refinance?
I think my first question would be, if you're speaking with the loan officer, hopefully, what their role in the process is. There's some big name companies out there where the loan officers really aren't professional, to be honest with you. They just take the application and then they pass that client off to 6 or 7 different people before it actually gets to closing. Like we talked about at the beginning of this, you want a professional loan officer who's going to be your point of contact from start to finish. I think that's the most important thing. Interest rate is an obvious one. You can shop rates just by giving basic information, what your credit score is, what your income is, without giving documentation. They should be able to provide you with a range of rates that they can offer you. And knowledge of products. There's a lot of different loan products out there today. And you really want the lender asking detailed questions, regarding your goals, what you're looking to do, to fit you into the best product for what those goals are. I don't want to throw rocks, but you don't want to just talk to somebody and they just shoot you out. Here's our 30-year fixed on an FHA loan, let's go. You want to see different options, different loan programs.
Yeah, absolutely. Because that one size fits all may not be the perfect fit for you, and there's definitely options out there for you as a consumer.
Yeah.
All right, my friend. Well, hey, this was fun. We're going to jump into the fire round really quick. So what I'm going to do is I'm just going to kind of really spitball you some questions or hit you real quick with some questions that we got from Instagram and Facebook, and just let you answer those very quickly. So jumping into the fire round. Loan recast. Somebody said, I heard a lender mention a loan recast. Can you explain what that is? Can you explain the benefits of it and when that would be used?
Yeah, loan recasts are something that's not talked about too much, but I think it's a great feature of a loan. Most of the time, a loan recast is being used when somebody is buying their new home before they sell their current home. So basically, you would buy your new home. Let's say you put 10% down on the new home, so you have 90% financing, and then you sell your old home. Let's say on the new home, your loan amount's $300,000 to start. You sell the old home, and you net $100,000 out of that, and you want to put that $100,000 towards the new loan. What a loan recast is, it's not refinancing. It's taking that $100,000 that you just made and reducing your principal balance on your new loan of $300,000. So it would now be $200,000, and your amortization, your payment is recast based on the $200,000 balance. So you'd see a significant decrease in payment. That's a question to ask your lender. Some lenders offer it and some don't. So that's a very important question to ask if that's something that you're thinking about doing. Typically, the cost of the recast is a couple $100 as opposed to several thousand for refinancing.
Sure.
So it's a great option, you know, whether you're selling the old house or, you know, tax time comes and you get 15 or 20,000 from the government or any sort of, you know, influx of cash that you have that you're not going to pay off the loan completely, but you'd like to lower your payment, recast is a good option.
Cool. Is it, so here's another one. Is it possible to close on two properties with the same day? Somebody said they were looking to sell their property, buy the next one. They didn't want to have to do a double move or do temporary housing. So is it possible to close twice or close 2 times in a day?
I'm smiling because we've done several of those together.
Yeah.
Yes, it is. Yes,
Always
it is.
stressful, but certainly possible.
Yeah, and you really want to make sure you have a great realtor like yourself, good lender, and a really good title or title attorney, because those three are going to be talking the whole time and setting everything up and coordinating it to get it done. Typically with those, we close on the sale, you know, early morning, and the buy in the afternoon. And the reason we do that is so we can move the funds from the sale to the new purchase in the afternoon. It's very easily done. Each lender treats that differently. We're great at it because basically what we do is we get a clear to close without the sale and just make it a funding condition. So basically the title company confirms that our buyer sold that morning, and then we just fund the loan. So it's a pretty easy process.
Yeah, and the one thing I'll add on there is if you're like here in Central Virginia, very easy to do. We've done a ton of them. If you're the property you're selling, if that's in a different state, you may want to get you certainly want to get your realtor on that end involved as well, because different states have different disbursement laws as far as when they'll send the money out. So you just want to make sure kind of everybody's on the same page. Right. Next question, and I'm sure this is one you get a million times a day. We're seeing record low interest rates. Like I was telling people for the longest time, like buy now because rates have nowhere to go but up. And then of course I look like an idiot and they go down. What's going on with rates? Where are they going? Where are they headed next?
You know, it's really tough to say. And I was in the same boat as you a year ago. You know, we all thought that rates were going to continue to rise. And here we are today in the mid threes on a 30-year fix. It's hard to tell. There's a lot that goes into it. One thing that you can track if you're looking to buy and interested in what rates are going to do is the 10-year Treasury note. That's typically correlated with our 30-year fixed rates. But it's just really tough. The market's so volatile right now. It all depends. It's a day-to-day thing with us, honestly. And my guess is as good as yours, unfortunately.
Yeah. It'd be interesting to see if they go any lower, but I still think that, you know, long term they're going nowhere but up. But who's to tell? We've said that before.
Exactly.
All right, last question for the fire round. Somebody asked, is it a bad idea to pull money out of a retirement account to use that towards a mortgage? What are your thoughts and feelings there? What are the pros and cons?
It depends on your individual situation. I mean, if there's no other money to use to put down for a down payment, I think it's a good option. I mean, it's your money. It's sitting there. Typically, you have to, each provider's different, but typically on a 401k loan, you're actually paying yourself back the interest. So if you have flexibility in your income, because they're going to take that payment out of your monthly paycheck, if you're okay with that payment being taken out of your monthly paycheck and you can still afford the new house, I think it's a great option. It's kind of like with the recast option. If it's something where you're doing it because you know you're going to have an influx of cash a couple months down the road, it's a great option. And most 401k providers, I think all of them actually, they have a clause in there where you can do a disbursement without penalty as long as you're buying a primary residence. So typically you just have to provide them with your purchase contract and they'll approve the disbursement and get it out to you. Usually they'll allow up to 50% of the vested balance to do that.
And what are the timeframes generally when that money has to be paid back in before there's a penalty, or the IRS sees that as you taking income out of your retirement?
If you do a loan, they'll set it up on, it depends on the provider. It could be like a 5-year payback. It could be a 10-year payback. And if you do a loan, yeah, and that's just for the primary residence purchase.
Okay.
But if you do a loan for it, there's no penalty, right? Because it's a loan and you're paying it back. The disbursement requirement, I don't want to get myself in trouble here. I would refer to the CPA on that one.
Smart man.
My understanding is it's 6 months, but again, don't quote me.
Check with your CPA, your attorney, and your congressman. Yeah. So very cool. Well, Adam, I appreciate your time. I appreciate you coming on the podcast. I hope people got a lot of value of this. If somebody has a follow-up question, if they want to discuss their financing options, if they just want to send you a check as a way to say thank you, what is the best way for folks to get a hold of you?
My office line's 804-299-5408, and my email's pretty easy. It's just adam@genevafi.com. You can reach me anytime and look forward to chatting with you.
I like how you got the Gjerulff part out of your email this time, because it used to be in there.
That was the number one requirement of joining Geneva. I was like, get Gjerulff out of my email address, please.
Adam would be retired on a beach right now with millions of dollars in the bank if he had just not had that email domain. So you heard it here. In 2 years, Adam's going to be a millionaire now that he's got just Adam as his email. So fantastic, my friend. Well, thank you for joining us. Thank you for making episode 5 possible. Thank you for putting up with the beach setting here, and we look forward to talking with you soon, my friend.
Thank you, Chris. Enjoy the beach. Talk to you soon.
Sir. We'll see you.
Bye now.
Thanks for joining us for the Chris Elliott Real Estate Show. If you have any questions or suggestions for future episodes, please contact Chris Elliott at chris@chriselliottrealestate.com or by phone at 804-980-1898. And please join us again next time for the Chris Elliott Real Estate Show.